So the strategy I use has been proven to boost your returns by about 300% instead of using a willy-nilly sell strategy.
Yeah, I don't like willy-nilly strategies. I want 300%.
What up?
Stocks, again, still. You actually had a pretty nice experience last week where you got to tell your subscribers that they had the opportunity to grab a 600% gain. That was from your Codebreaker Profits. You have an investment research service that you run, but you were able to tell them that they had the opportunity to grab a 600% gain. But you kind of had an interesting take on it because you didn't tell them to close the position. And that's important. So let's get into that. Why?
Yeah, so the question I get the most from readers is, when do I know when to sell? So, Wall Street, CNBC, all these channels, the talking heads, always talk about what stock to buy when, what the hot stock is right now. But nobody ever really talks about, hey, you need to sell this one or sell that one, or you've got a good enough gain here, take that off the table, or hey, dummy, you're losing money, it's time to sell.
Well, I think that's a big misconception people have about investing too. It's like anything. You get all hyped up to buy something, but who's excited to sell? Who loves the process of selling their car? I think, but people forget that's an important part of the process too.
And there's a lot of people that make their money taking advantage of the people that don't think about how they're going to sell. So we have to put just as much emphasis onto when we sell a stock, who we sell it to, and to what or for what price, as what we do, all the analysis for when we're buying it. We all talk about illiquid versus liquid assets. You have to weigh that in.
Do we all talk about it though? This might be a good opportunity because, let's say I've never traded a stock before. When I hear the phrase liquid or illiquid, that's referring to what? The volume of shares trading? And yeah, thank you. That's very helpful.
Yeah, so you think of a typical illiquid investment is your house, right? So you put that stake in front of your house, tap a for sale sign in, and it might be 6 months, a year, maybe more until it sells. So that's very illiquid. There's not people lining up with a set price in mind. Where a stock, you can sell that, shares of General Electric or, Apple, like that. You put the price tag out and people are going to buy it instantly. So that's a liquid asset.
Volume is something that you can track. So if you're using a standard, investing website or something to track stocks, you can always look at the volume, how many shares are trading in a given day, how much attention is being paid to that stock. So you can determine, am I going to be able to unload this stock super fast, or am I going to have to maybe wait a few minutes and not get the price that I want?
Yeah, but really there's just three things that you have to understand, and we'll detail those three things. But if whether you're a long-term investor, you use one of these strategies. If you're medium, a year or two, medium-term investor, use the other. And then if you're doing short-term trades, use the third. And if you use those, you'll drastically reduce the amount of risk that you have out there. The first thing I want folks to look at is the idea of a trailing stop. And it sounds complicated. We get a ton of reader questions about this, but just think of it as a way to limit your loss. So we could say, let's just say we're buying shares of Ford for $10. So with a trailing stop, we can say, hey, I want to protect myself from a 20% loss. So we would put that trailing stop in at $8, right? But then if shares of Ford double to $20, we're not going to get out when it goes to $8. Our trailing stop is always going to follow it down that 20%.
It's exactly what it sounds like. It's trailing the stock. So if your stock is moving up and it's trailing it from a certain distance behind, once your stock starts to slide back, the stop doesn't stop. So it's going to keep you from flying backward.
Exactly. And that's the doing the math, doing back testing, historical look at the stock market. That is the very best way to prevent big losses and maximize your gains. Every once in a while, you'll get out of a stock a little early that hits a rough patch or some volatility. But most of the time, you look at our portfolios, it works wonders.
Trailing stops are a great tool for folks to look at when they're getting started investing because it's one of the easiest things you can do. Most brokerages or brokerage accounts that you have are going to have it. It's just a way to automate your sell strategy. strategy. That way you don't have to be glued to what your stocks are doing every day.
Yeah, if you want something more active, or if you're buying stocks and with a 1 month, 3 month, or even 6 month time horizon, there we look at things. I mean, there's all sorts of different variables. A really popular one that I really like is just looking at moving averages. So this is kind of investing 101. I remember 15 years ago being taught this. So a moving average is simply a mathematical formula that just calculates the average price of a stock or any asset over the last X number of days. So with Ford again, if it's going slowly up, the moving average will be slowly moving up. It's usually a little bit behind the stock depending on the action. But what we do is we plot that moving average, and we get a nice steady a plot of the stock price, and then the daily stock price kind of fluctuates above that. But we get this long-term trend and then the day-to-day action.
Yeah.
And typically, when the stock price is above that moving average, it's bullish. It means the stock is likely in an uptrend. But when it crosses below that moving average, it's a clue that something has changed, that all of a sudden the average price is going down, or the stock is below that. And a lot of folks use that as a sell indicator. So when we dip below that moving average, that's when we sell. And then when it comes back up, you can use it as a buying indicator.
Yeah, so again, it's another term that sounds or does exactly what it sounds like. It's the average movement of the stock. Here's what you should expect it to do based on the past 120 days of movement. And then you can make a decision based on that.
Yeah, and you can scale it out. You can look at, 270-day moving average, 100-day. You can look at a 500, 300-day.
Just like you can find trailing stops in your brokerage and different kinds of stops, which we can cover in a different video. We could honestly do a whole video on stops.
A series on them.
But with moving averages, that's something that you can find within Yahoo Finance, which within most popular free services that you can look at stocks on online.
That's kind of the bane of the industry. There's a lot of indicators out there, but you don't need all of them.
You can definitely overdo it.
Yeah,
that's for sure.
And you can confuse yourself, and there's just some real basic metrics that you have to understand. That moving average is key. And I threw something up there, the idea of the average trading range. I threw a softball up. I was hoping you'd hit it, but
nope. Sorry, Dad.
The average trading range is think of a road. So that's a little bit more technical. This is what we use in Codebreaker for that 600% gain, or the 600% profit that we saw. So we have the moving average. Think of that as the middle of the road, right? That's the yellow line. That dictates the middle of the road. But what about the guardrails? And so that's really helpful as a short-term trader. So we're going long-term trading, trailing stops, mid-term with the moving average, and then shorter term with the average true range, average trading range, however you want to look at it. That involves the middle line plus adding these guardrails. So a computer makes a trade based on two different patterns. They look for unusual buying activity, and they look for things that are out of range. And so that's where this road system really plays off, those guardrails. So what we do is we go out and we just look for things that are hitting the guardrails, because when you hit a guardrail, I'm sure you know, you bounce right back into the middle of the road. And so these computers, the algorithms are picking up on that and sending stocks. So
but it's an indicator that something is probably going awry with your stock.
When you hit a guardrail in a car,
you hit a guardrail, you
you're
either need to wake up or you need to, I don't know, put your glasses on.
So what we do there is we use the upper end as the selling indicator, and then we use the lower indicator. So when the stock dips too low, we use that as a buying indicator, and it works. I mean, you've seen it, 600% gain. So there's different variables for that. A lot of guys use what's called Bollinger Bands. Yahoo Finance has that.
Yeah.
So you can add different variations of that.
Well, and this is great because it's such a good visual representation of what's happening with your stock. It couldn't be simpler. It's like your stock is traveling within a tube or within a channel, and so you can really make decisions over which guardrail is being hit.
Exactly. It's a no-brainer. So that's three really simple indicators that are free on virtually all software packages. Any online broker will have Yahoo Finance. Using a 25% trailing stop, 25% is probably a good place to start for long-term investors.
Yeah.
The moving average, 120-day moving average is perfect, super simple. And then as you get into that shorter-term trading, that's where like the Bollinger Bands, that road system or the Keltner channels really comes into play.
Well, and it's also probably worth mentioning, shameless plug, if you head to manwardpress.com and look up any of these indicators, we've written things about them. So, it's a good place to start. Head to manwardpress.com, use our search box, check that stuff out. So now you have the tools that you need to sell, which means you can keep more of your profits and keep your losses to a minimum.
That is a liquid asset worth celebrating.
Oof. Hey, thanks for watching. I hope you can use this information to become a better trader. Keep watching. We have plenty of info in the pipeline about investing. If you have questions, leave them below and be sure to subscribe.